Hey everyone, thanks for joining the live stream. It is good to see you guys. And it was a positive day on the live stream today. Good to see a positive day. It's been a little while since we've seen a green day, and it was across all the biggest stocks: Nvidia, Google, Meta, Tesla, Broadcom, AMD, Palantir, CRM, and consumer staples went down. I think the reason for it was we had an inflation report early in the day, and the result was that inflation went down, and that's good. With inflation going down, it's going to compel the Federal Reserve to start cutting rates sooner, and I think that will spur a market rally as rates go down. Stocks are preferred because as rates go down, investors get paid less interest on bonds and other investments. So they'd rather take a higher risk, but get a better return out of stocks. So I think that report that came in that showed that inflation did come in better than expected was a lot of positive news. So that was good to see. Um, it really took some stocks that have been beaten down up, which is good. It's good to see Google up. I think Google has been having a tough year in 2025. That announced was Adobe, and I see Hyperwizard. Good to see you. You want to take a look at Adobe? That's going to be after I get done. We're going to look at Adobe. We're going to look at Adobe. We're going to look at the earnings. I already read through the earnings, and then we're going to take the earnings data and put it into the valuation that I have for Adobe. I value companies based on free cash flows. I also look at earnings per share. And remember that stocks, in the short term are a voting instrument. Depending on sentiment, some stocks get really run up because a lot of people like the stock for whatever reason. Might be that they have good fundamentals. But over the long term, it's a weighing machine. And we need to weigh the value. True value of a company is the future free cash flows they're going to produce. So we'll do the full valuation of Adobe from soup to nuts. And I'm already an Adobe stockholder. I think it's a terrific company, and I'll tell you more when we get there. So this is the heat map of the stock market. It was interesting. Looked like consumer staples sold off. Healthcare did not have a good day. It was a good day to buy healthcare stocks. I did buy healthcare stocks today. I bought plenty of them today. I'm loading up on healthcare. And Apple keeps on the losing streak. So that is interesting. Now, I believe that Apple is a troubled stock because if the economy goes into recession, Apple's going to have a hard time selling more phones. And I think internationally, Apple is dealing with a lot of competition. That competition is just going to continue to get better at beating Apple with better devices, less expensive devices. Apple's coming out with a lower cost phone. And I think that's going to cannibalize their big premium phones because people might be like, hey, I'm getting an Apple, but I'm getting it for $600 versus $1,100 or $1,200. Well, that's less revenue for Apple. So they will still sell a unit, but they used to get $1,100, $1,200, but now they're only going to get half of that. So I think that's going to have an effect on their financials. To me, that shows that competition is getting to Apple. Apple is realizing we have to have a less expensive device in order to compete and keep users of our devices. If not, they're going to go to another company. So I think it's a sign that Apple has a lot of competition. Now, the most desirable businesses are those that have very few competitors, if any. And as we see Apple now compete against other businesses, I think their moat is under question. The amount of competition they're getting, Apple's not the only company that creates, phones, smartphones. They might be the best brand in the space, but that could go away quite quickly. Samsung is a pretty good company. They produce a really good device. Google's into devices now. So you have a lot of competition that is facing Apple, and I think that's part of the story that's weighing on them. All right, so I'll take a look at Apple. It'd be interesting to look at Apple. I'll tell you why that's one of my top sells. I published 2 videos today. One was my top sells, one was my top buys. I encourage you to view them. It's really the stocks that I think are stocks that I would sell, and then stocks that I am buying. So take a look. All right, so looking further into the market today, technology led all sectors. They're still struggling for the year, but they've done terrific over the last couple of years, so nothing to be too worried about. In last place was consumer staples. Healthcare was in second to last place. Consumer services was in second place, and that's Meta, Google, Netflix, and so forth. All right, so that's how things played out. Looking at the big stocks, and this is how, the indexes were positive. They're in the green because some of these big stocks showed up. NVIDIA really showed up today. If you're an NVIDIA stockholder, you had a good day because it's been a rough year. And Microsoft went up, Amazon went up, Alphabet went up, Meta went up nicely. Berkshire was flat. Broadcom went up, and then Tesla went up. So a lot of big cap stocks had a good day. I think that's why the indexes were in the green. It was nice to have a green. It'd been a little while since we'd had a green day, so it was good to see a positive close in the market. So today we're going to go over Adobe. Let's see if there's any others that are worth taking a look at. Viking Holdings, I think they do appliances and stuff. That doesn't really float my boat. And I think that's the only one I'm going to look at that announced earnings today. Is there anything coming up tomorrow that's worth mentioning? Let's take a look. Dollar General tomorrow. I think they pre-announced, and it was bad news. So tomorrow DocuSign announces, and for sure I'm going to look at that. I'm going to DocuSign stockholder. Futu also announces. I've been buying into that. That's a Chinese financial services company, so I'll be buying into that. So tomorrow we've got some interesting companies. ServiceTitan's a new SaaS company, software company that does software for like project-oriented trades, like people that are building, constructing, making homes, doing construction, and they're giving it a go. So tomorrow I think we're going to have some pretty neat little companies, and DocuSign's been a good winner for me, so I look forward to seeing what they're going to announce. All right, so I'm going to jump into Adobe, but let me take a peek here. It looks like Mike, the dividend investor guy, Path and S both dumped after hours, both misguidance. So Path, I have some comments on Path. So let's take a look at both. We'll take a look at both, Mike, see what the heck's going on. All right, and then Carlos, good to see you. And yeah, S could cause S. Well, I don't know. We'll see. I think S was quite a bit smaller. That was kind of like the small player in cyber. Let's take a peek, and we'll take a peek at Zscaler to see if it's causing a sell-off in Zscaler, because you might be right. All right, cool. Thanks everybody for joining. Jerry, good to see you. Jay Zev, how you doing, man? Good to see you. Yeah, so we'll take a look at S in a bit. Let me get through Adobe, Mike, and then we'll get over to S and Path. I got Adobe all queued up. So first, Adobe's selling off, and Adobe, as a company, right? I have a lot of respect for Adobe. Adobe's a high quality company. When we think of Adobe, let me see if I can get some imagery about, see here. So when we talk about Adobe, we're talking about a company in the categories of software that they operate in. They're either the best or near the top. And when you talk about creative software for creating videos, creating content, having a very professional and impressive appearance digitally, whether it be on your website, the communication that you send to your customers or prospects, Adobe is at the top of the food chain there. There's no other company that is as strong as they are in that creative process. I've known of Adobe for 30 years, and you know, they've built the business from it being tiny to now being a pretty significant company, and I'll show you that. I like the categories they're in. Again, they're either number one or near the top. They're a player in all their markets. So I like the company, I like the business. When we think about desirability, and I'll get to the desirability quadrant a little later, let's take a look at their financials. So when we look at the Adobe financials, the revenue grew really well, 10% growth. And they recorded, this is their first quarter. They have a fiscal year where the first quarter just ended. And they had 10% revenue growth year over year. They keep getting bigger. They keep growing at that 10, 11% clip, which is very good. They also expanded free cash flow much faster than I expected. So I'm good with positive surprises. Their free cash flow from operations was almost double in the quarter than what was expected. That was very positive. So I had to update my model of cash flow. I'm going to grow it faster, which is going to give them a higher value because more cash flow. So that looked good. They bought back shares. That was very smart because I think their stock has been trading below intrinsic value. And I was reading up this morning, I was looking at super investors because I think there's always something good to learn from some of the best investors out there. And I found my way back to Pat Dorsey. That's my favorite investor right now. It has been for a couple years because the more I dig, the more I align with him. I totally get what he's trying to do. And his website's really good, by the way. If you go to his hedge fund website, he basically puts out his philosophy and his strategy and how he goes about things. And one of the things that he says is that the two things that he really looks for in a business is the moat, competitive advantages, and then that company really utilizes capital very wisely, very effective and efficient use of capital. One of the points he makes in there is if a company is buying back shares when their stock is above intrinsic value, that's a bad idea. You're buying shares above your intrinsic value, which means that you're buying at a premium. Where if you're buying shares when your stock is below intrinsic value, it's a great idea. Adobe, I believe, is trading below intrinsic value, so it's a great idea. I know I'm digging deep on that topic, but again, the more I learn about Pat Dorsey, the more I agree with him. And I'm like, yeah, I agree with you. And that makes total sense. So I wanted to pass that along with you. So Adobe's growing really well. They're growing and they're reaffirming their guidance for next year. Next year should be a very good year. When we look at their financials, just strong financials. And I'm going to show you their margins and so forth a little later. So just comments around their moat. The software industry is very profitable and it's very hard to switch over. Like Adobe has certain products where the people that are using those products, there's no alternative. It's like, no, I like the Adobe product because I can do all these things. I can't do it with other products. The switchover cost and the switchover knowledge cost is just too high. So people stick to the Adobe products. I really like the moat. I really like how Adobe has really strong barriers of entry. See how high their revenue is, 5.7 billion for the quarter. Cost of revenue, 622 million. It's almost 90% gross margins. That's a beautiful thing. That's wonderful. It's actually, yeah, it's just under 90. It's probably going to be 88, 89%. That's awesome margins. If you're like General Motors, your gross margins are like 15%. It's really low. So that's an undesirable business. So I think Adobe has a strong moat. They have very strong margins and they create lots of cash. Balance sheet looks great. Lots of cash, manageable debt level. I think they have more cash than debt. And then this is the line that was a positive surprise is, hey, last year we did 1.1 billion of cash from operations. And this year we did a whopping 2.4 billion. I think last year they had some expenses related to they were going to acquire a business. The last administration president, they were kind of, how should I say this without being overly mean, is they just didn't get it. It's like Adobe wanted to acquire this other business. They didn't allow it. They had to cancel it. Adobe had to pay $1 billion. I think it would have been good for that other business and it would have been good for Adobe, but we move on. And that's why this cash flow went up so much. And CapEx, they don't have to put much back into the business. Again, this is a desirable business. This is all intellectual property sales. You're selling ideas in the form of software that get delivered to your customer. So the financials to me looked really, really good. Let's take a peek at stock analysis, and I'll point out a few things, and we're going to go to my valuation model and value Adobe, and then I'll share with you the desirability quadrant, and then I'll make a decision on Adobe. So this stock here has really been struggling. And again, Adobe's a really well-known company, $190 billion in market cap, revenue 21.5 billion. Forward P is just 21, and they're growing at 10%. So don't know why it's only at 21, growing 10%. You have margins close to 90%. It's a fabulous discount. Analysts agree. It's discounted by 29% according to analysts. Year to date, the stock's doing okay. It's not, crashing and burning. It's down 1.33. If this sticks, they're having their earnings call right now. If this decrement to their stock price sticks, then they'll be down, I guess, 4% or so. When we look at their financials, growth. I like revenue growth. It shows that their products are really getting it done. And when you look at their margins, 89%. Beautiful. Awesome margins. Incredible margins. The story that has been out there is AI is going to cannibalize the Adobe business. AI is going to create all the images for the world. It's going to create videos. Well, I'm waiting. AI. AI isn't doing anything. AI is but a feature in a lot of software experiences. And that's what the market's realizing now. But that whole realization hasn't caught up with Adobe yet. It was kind of a story that was against Adobe, but that story is proving to be premature. At best, it was premature. More realistically, AI is going to be but features within the software, experience for users. And Adobe's doing a good job of integrating AI experiences within their software. That's all positive. So I think this is going to be, the whole AI scare is going to go away, and investors are going to realize, hey, this is a high margin business that's growing, generating tremendous cash flow, I think more investors are going to enter the picture. When we look at this stock, 25 analysts cover it, lots of analysts cover it. Some are optimistic that it's really priced too low and they have a high price target. The worst case scenario analyst thinks it's priced too low. So everybody agrees Adobe is being discounted. And I'm going to add myself to that list and I'm going to give you the details as to why I feel that way. They're going to keep growing. Look at that. Consistent growth and expansion to their earnings per share. Who doesn't like that? That's just great. Their fiscal year is going to end November 29th of 2025. And they're expecting earnings per share of $20.81. So the forward P is 21, which I think is wrong. This is a growing high margin business. It should be higher. You see some PEs, let's say a Palantir, I don't know if that's 150 or 200. They're growing at like 30%. So I'll kind of give them a salute on that. Their margins are near Adobe's, but Adobe's much bigger than Palantir. And as Palantir gets bigger, that growth rate's going to get smaller and they're going to become a company like Adobe. All right, so I've seen what I wanted to see here. Now let's jump over to my valuation. And here it is. So I've updated the cash flow. And the cash, I was growing it at 8%, but now I've grown it to 10%. And in the first year, I'm going to grow that by 20%, because the cash flow just surprised me to the upside. I think that's the best, most accurate cash flow model I can put out there. All those cash flows, when I discount them by 8%, and that 8% over time will go down because the Federal Reserve is going to lower interest rates. As interest rates go down, when you have a lower discount rate, the value of the company goes up. Now, all those cash flows based on an 8% discount rate are $279 billion of value. When I add cash and take away debt, they have more cash than debt. So we have $280 billion of value in Adobe represented by cash. That is the expectation of cash in the future that I have on Adobe. The market cap is below that by 44%. So the stock price is being discounted by 44% if you compare it to the cash flows of the company. So that's tremendous. That's really, really good. When we look at earnings per share, the market tends to look at earnings per share quite often. So it changed just a little bit, but that it's discounted by 24%. Remember, analysts felt that it was discounted at around 28, 29%. So I'm agreeing with them. Collectively, this stock is discounted. Now, when I look at a company like Adobe, it's a very well-known business. I've known of their success for a long time. And when I look at the desirability of Adobe, to me, it's clear that they have strong moats. They have strong moats with very strong margins. They're growing. Customers like their product. All those things are there. So they are a company that I put in the green. They're a company that I put in the green representing strong moat, high margins, high cash flow, very desirable business. And I think more super investors are going to realize that Adobe is a good place to be. Right now, the super investors that are in the stock include Poland Capital, Hillman, Wallace White's Viking, Catalan Capital, Tory Funds, Jensen Investments, and Linsell Train. So these are kind of like the lesser known super investors, but the super investors are in. And I think the list is going to grow. I think the list is going to grow. The whole AI scare, it was just a story. It was like a fantasy, a fairy tale. So I think that for me, I am going to be a buyer of Adobe, and I like it when the stock market is inefficient. It's ineffective. Another thing that Pat Dorsey stated in his content was that usually all the information that's quantitative numbers, and so forth, especially historical numbers, that's all efficiently priced in a stock. But all the qualitative aspects of a company, qualitative being what's the AI story going to do to Adobe? How are they going to grow? Is their product, really successful? Are they really successful in their markets? That's qualitative. That's where a stock is not priced efficiently. And it's up to the informed investor to make those decisions. I happen to believe strong moat, awesome margins, momentum, and growth. It's represented by 10% growth on a very large revenue number. And they're not going to go anywhere. They're just going to continue to grow. Analysts believe they're going to keep growing at 10%, which is a very good growth rate. So having said that, I'm a buyer of Adobe, and we just went through a full evaluation representative of what I do as I invest in companies and what I do in this community. It looks like we've got 20 strong on the live stream. I appreciate that. I also appreciate people that have paid to be members. There's one on the stream now. I appreciate it very much. So thank you so much for doing so. Having said that, we're going to jump into what Mike, the dividend investor guy, wanted to talk about. And we're going to get into symbol S. Let's take a look at symbol S. So it's Sentinel-1, and Sentinel-1 is a stock that we've looked at recently, and it's a cybersecurity stock. Now, it's a small company, and when we looked at it, I was nervous about the stock because you look at the price action has an influence on me, right? Because a lot of investors are looking at this. It's a $6 billion market cap. Now, when we go to the fundamentals, it has incredible growth here, right? But there was stuff in the fundamentals that I didn't like the losing of money. And when we look at gross margins are good and they're expanding because they're getting bigger. That's very good. Now I don't think I'm looking at the most recent numbers. So we'll take a look at their earnings announcement. Let me take a peek at that. Let's get to the latest and greatest and see what did the market not like? Why is it selling off by 12%? Do we agree or disagree? So revenue continues to grow nicely at 29%. They're selling into bigger customers. So this means customers with annual renewable revenue, ARR, annual renewable revenue of $100,000 or more grew by 25%. Good. Okay. Gross margins, 75%. Nicely done. Cash flow margin. So they did cash flow. Wait, this is a negative, sorry. This means that their cash flow is getting better. It's not quite positive. When you see numbers in these brackets, it represents a negative. That's the accounting formatting that you'll see. They have cash of 1.1 billion. That looks good. So their cash is getting better. For the full fiscal year, they had negative cash flow of 11%. No, cash flow margin was 4% compared to 11% negative before. So let me make sure I read the quarterly correct. So it was -2 compared to the previous fourth quarter at -4. So it got better, but it was still negative in the fourth quarter. I would have liked to have seen that be a positive number. I think my concern about this company was you're not making enough free cash flow to make me totally believe that you're going to be super valuable. And it looks like they took a step backwards. Outlook. So full guidance for the year, they're going to be basically $1 billion company. So let's take a peek and see where are you at for the full year. This is trailing 12 months. I guess I could have stayed there because they gave me the number. Sorry, I'm jumping around so much, guys. So total revenue is 821. So you're going to be roughly $1 billion, which is going to be 200 million of growth. So that puts them at 25 to 27% growth. Still very good. Still very good for the new year. So revenue growth is still solid based on their guidance, and you see how their margins continue to expand. As you get bigger, your margins expand. So that looks good. So I am seeing a lot of good things. The one exception being cash flow. Cash flow is still the problem. And I use cash flow as my principal valuation. So it's like, that's like the most important part of financials for me. Balance sheet should be fine. We've got, short-term investments in cash. They probably got that when they IPO'd. So I don't think that's a problem. They got about $1 billion there. All right. They don't have debt, right? So they do not have any debt. Good job. Debt is a bad thing. Okay. Cash flow. Okay, so cash from operations for the year was 33.7 million. Good job, guys. Good job. And plant, property, and equipment was 2 billion. So they're roughly $31 million in free cash flow. Now, I expect their cash flow is really going to go up nicely. It's not going to go up by like 10, 20%. It's actually going to go up like big chunks, like 30%, 40% for like the next 2 years. It's probably going to get up to 200 million very quickly. Having said that, what is there? So they're going to be $1 billion business with margins at 75%. So they're going to be at like 300 million in free cash flow per year if everything goes right. Now I'm looking at their financials and I'm thinking they're operating the business really well. They're growing really well. Nice growth. They're growing faster than CrowdStrike, but they're smaller. Okay, they're only $1 billion. So if I take 200 million and multiply it at their growth rate and margins, multiply it times, let's call it 25 times, we're going to get to about 5 billion. And they have about $1 billion of cash. So it's about a $6 billion value business, just kind of back of the napkin, do a quick valuation. And they're at 6 billion, but tomorrow they're going to be priced down by 10, 13%. So they're going to be at like 5.5 billion or so. So they're going to have a small discount. It's not enough discount for me to be excited and even be an investor. I think these guys need another year to get their financials really groomed well and really show that, hey, we're a 200, 300, $400 million free cash flow business. And then once that happens, this is going to be worth 20 billion. But they have to execute to that number. Their big competitor is, they have a number of competitors. CrowdStrike. They compete against Palo Alto. These guys were up nicely. I think they're overpriced. This is one of the stocks that I believe is highly overpriced. I think they have a very high market cap. You can buy Sentinel-1 for 6 billion, and these guys are 86 billion. They're growing at 29%. That's the growth rate that Sentinel-1's growing. Sentinel-1's 1 billion. These guys are 4 billion. So it's not like CrowdStrike's 10 times bigger. No, CrowdStrike's 4 times bigger. But you're paying 86, right? So 6 into 86. 86 divided by 6 is going to be 10, 16 times. So CrowdStrike, the market cap is 16 times higher, but it's only 4 times bigger. So there's better value in Sentinel-1 than CrowdStrike. The one that I'm investing in is Zscaler, and they did have positive earnings, but the market's just been horrible, right? And stocks have just been sold off for whatever reason. These guys are growing about the same clip as Sentinel-1. And I think when I made a decision on Zscaler, I was also looking at Sentinel-1, and I, one second, and I decided on Zscaler because the growth is about the same percentage, but the revenue is more than twice as big. It's 1.5 times bigger. So that looked really good to me. That's why I went with Zscaler, and they have, I think, a more mature business with more mature financials. I think Sentinel-1 can get there, but they're just, it just needs more time. It needs more time so that we can get the financials to be a lot better than that. So that's Zscaler. So Sentinel-1 is not a buy. I think it's potentially a good buy in the future, but for now, the answer is no. If it were to really just get hammered, let's say it went down to $12 a share, I probably would be interested, because then I would see a discounted company and the market cap would be so low that I would be tempted to get into the stock. So that is Sentinel-1. After hours, it's not doing well. So, all right, so that is Sentinel-1. I don't know, Mike, if you have any questions on that. And yeah, so, and what is Zscaler doing in after hours? It's not tanking, right? It's down a little bit. And Zscaler is not breaking any records, right? This one, part of the reason that I like them was I'm seeing quality company growing, margins, all that good stuff, but the stock wasn't going anywhere. So when you have a business that's growing like this and the stock isn't moving, what's the rub? And I think it's because the automatic buy for a lot of investors was go buy CrowdStrike. It's almost like nobody really thinks anymore. Hey, go buy CrowdStrike because everybody's buying it. Remember the phrase, in the short term, it's the stock market is a voting machine. It's a popularity contest. Well, hey, man, if you follow the crowd, you might end up losing a bunch of money because it's not based on fundamentals. I think this one is priced too high, and I'm going to stick to my guns on that. I do have valuations on both CrowdStrike and Zscaler. Let's take a peek at those. I don't have one on Sentinel-1, nor am I going to start one because I think we need more time on that one, like get some better financials, and then I could have a better forecast for their cash, and then I could truly say, hey, this is what I believe the company's worth. So CrowdStrike, I think, is overpriced by 55%. And it's based on free cash flows and even their earnings per share. I can't get there. The PE on CrowdStrike's really high. 100. Come on. Again, you got a company that's growing at the same rate as their competitors. I just showed you Zscaler and I just showed you Sentinel-1. Growth rates are about the same. These guys are not like gigantic. If this was like $40 billion and they were growing at 29%, I would be like, yeah, these guys are really making it happen. So that's a little more evidence of my conclusion there. Zscaler, I think, is actually discounted by 41%. And their cash flows are going to be tremendous, 78% discount. So Zscaler is the lane that I picked. It hasn't been a total winner for me just yet. It's been okay. I don't know if I'm making money on it or not. Let me take a quick peek. Making 2%, but on a year like this, right, that's a win. Some stocks, it's like, man, I only lost 5-10% in 2025. And I've just started buying into Zscaler. So I haven't had it for that long. So Zscaler is going to be the stock for me in cybersecurity. One last threat to Sentinel-1 that we need to be aware of is when we think about cybersecurity, right? It's not like these guys exist in a vacuum without, bigger predators being lurching in the kingdom that they operate in, or I should say the jungle. But what I would tell you is, like Microsoft is an example. If this space gets bigger, like, hey, cybersecurity is driving billions of dollars, let's say $500 billion of revenues, you better believe Microsoft, Google, Amazon, all those bigs are going to move into this space. So all these, I would put every single one of those cybersecurity companies in the green and in the gray, because they're all going to have to deal with Google, Microsoft. They're going to have to deal with Apple, who does their own cybersecurity software, and they package it with their solutions. There's a lot of players out there that would move in on that space and crowd up the space and just make it more competitive. So it's not a pure moat, okay? Sentinel-1, as well as CrowdStrike and Zscaler, Palo Alto, they're going to be competing in this space. This space gets a little too overheated. There was one stock that I put an opinion out there, and some other investors, which I appreciate the comments from those other investors, they took, they were like, no, we disagree with you, Victor. And so far, my house has been correct on Arista. Arista wants to say that they're a cybersecurity play, but they're mostly networking, in my opinion. But having said that, I was saying they're overpriced in this zone, and now they're doing this. And they did it after an earnings announcement. And the management was basically saying, hey, we're seeing more forces that are competing against us. We're going to have a hard time growing. So the Arista Networks folks that were tracking this stock, they were really disappointed because, hey, can't this just continue to go up way up here? I don't know, go up, 2,000% like NVIDIA? No, because you don't have an NVIDIA-like situation. You do networking. Cisco's been doing that for 30 years. That's not an exaggeration. You do cybersecurity. Guess what? There's been competitors in that space for 30 years. Are you a quality business? Absolutely. But you're not this type of business. You should be going up over 5 years, maybe 100, 200%. And when I look at the valuation of Arista, they're grossly overvalued. I stated that. I made videos on it. And some other investors were like, no, we disagree with you. And I go, hey, that's great. Please always offer feedback. If you have an alternative point of view, I want to hear it. I might learn something from you. But in this case here, I'm still sticking to my analysis. So far, the stock's tanking. So I'm like, yeah, that's what I thought was going to happen. And the market's correcting it. All right. So we went over Sentinel-1. The other one that you said was tanking is Path. And Path is kind of a AI darling that was supposed to, what UiPath does is you train if you think about, like, you're at work and you have a particular process. Let's say at the end of the day, when you complete a service order, if you were like in a service industry, you'd basically like complete the service order, make sure all fields were filled out, information from the customer was entered into every field, and it was closed out. Now, for a long time, you've had a person updating all those fields, and it takes that person 15, 20 minutes. Well, what these guys claim is you can teach your, what is in essence is UiPath will you'll design that workflow, and then the computer will do it. It'll be like machine learning, and it'll save you a lot of time and a lot of cost. Brilliant. So they really came out, and it was a really exciting idea. But the excitement hit a wall. It's like, well, if it's that cool and exciting, you should be growing at 100%, but you're only growing at 9.3%. This is where the sound effects should be coming in, where it sounds like wah, 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 disappointment, unimpressed. That's what the problem is. You come out with the huge idea, humongous, and then you deliver growth that is really underwhelming, and you're a tiny company. Those cybersecurity companies I just showed you are growing at 30%. That's more exciting, and they don't have a big idea. They're doing something that's been done for a long time, which is cybersecurity. You're doing something that's totally innovative. What may be the case is they're selling their solution. Customers are not getting the result they're looking for. Hey, we spent time and energy deploying the UiPath solution. It didn't work. It brought us very little to no value. Sorry, guys, that's not going to work in the marketplace. You sell intellectual property, you sell ideas, they have to work. They don't work, they don't pay for it. It's not like you're just selling, 20 pounds of, a material. No, you're selling intellectual property. So that's what's ailing this company now. When they came out with their ideas, and even back here, when I was seeing these growth rates, I'm like, this doesn't look right. This is not fast enough growth. If you came out with an idea that's that big, customers should be like tripping over themselves trying to get to you, and you should be growing at 50, 100%. And that wasn't the case. So UiPath, not a big surprise. Let's take a look at their fundamentals. I do a quick valuation on them. Looks like Stock Analysis loaded their financials. Nice job, Stock Analysis. That was quick. So free cash flow, 305 million. That is positive. Gross margins of 82%, excuse me. That is positive. At their growth rate of 10%, right? So let's say we hit that free cash flow with 20, we get to 6 billion, assuming they don't have any debt. And the debt level they have is, wow, look at that debt. Why do they have so much debt? They have $1.6 billion. Oh, no, million, sorry. Man, I got to look at the details. 74 million. Okay, they got plenty of cash, 1.6 billion. So we were at 6 billion plus 1.6 billion. So they're at $7 to $8 billion value company. Right now, they're valued pretty fairly. They're going to be discounted even more tomorrow. So they lost a lot of energy and momentum. This is now discounted. I would say they're worth 67 billion tomorrow. If it stays at a 15%, a stock price reduction, that means these guys are going to be priced tomorrow as a 5.7, $5.8 billion market cap company, and they'll be worth 6 to 7. So there is a discount there. Now, is the sell-off going to stop tomorrow? They fell off a cliff. Boom! They went from $20 a share to $11 a share really fast. They're going to fall off another little cliff. Not as bad, but it's still pretty bad. Huh. Interesting. This is becoming interesting to watch because I caught another software company. So AppLovin, I made videos on AppLovin months ago where I'm like, this thing's like, it's kind of out of control. This thing's overpriced, right? And it's a good business. It just, the market's priced this thing way too high. It starts with quality and then the market just took off too much. Well, I ended up reevaluating AppLovin, and on Monday of this week, I put a buy order, and I actually lowered the price by 10%, thinking it'll take a couple months to get there if it gets there. But I'd be a buyer of AppLovin. And guess what? It got there on Monday. That really bad Monday we just had. So right now I'm up like 10% on my AppLovin stock. I bought on Monday and Tuesday. And that's an example of this is a quality business growing really well, really good margins. And just the market, you see the big moves, 75% gross margins. You see the big moves that the market has. The market in the short term is a voting machine, and fear really drives markets. It got the fear of missing out. Oh man, gotta buy it, gotta buy it, gotta buy it. And then, oh my God, this thing's overpriced. Sell it. Boom. It went down 50% very quickly. And it's become a pretty significant cap company. So that's AppLovin. Can UI become something like that? Absolutely. If this thing would be priced at like 5 billion, I'd have to buy a few shares, man. Because this thing's worth far more. They got to fix the we're not growing problem. Got to fix that. I'm going to take this as a homework item and go through their financials and really look at them closely. If they can prove that they're going to grow, these guys are worth more. But for now, they're going to get taken behind the woodshed and beat over with a big stick. 15% down. Oh man, that's tough. Man, tough. But that's what the game we all elected to play, man. In a way, this is a contact sport. Buckle your chin strap. So, Mike, we looked at your two stocks. Good luck to you, buddy. And hopefully we find some good opportunities out there. All right, so we went over those. Let me take a peek. I think there was a request out there. Let me make sure I catch up with that really quick. And say hello to everybody who's joined. So, all right, Hyper Wizard, I covered Adobe, so I think you're good to go there, sir. Carlos, good to see you. Jay Zepp, what's up? Krishna, we are entering bullish? Not yet, buddy. We're in a bear market. What I would say is discounted prices are always good news. If we find great businesses that we can buy at great prices, that's good news, but we're in a bear market. So what happened to Pfizer today? The whole healthcare space was selling off. So it's not Pfizer specific, but I'll take a peek. I will take a peek. Spotify. So Joey, so I love Spot. Every time I cover Spot, and here's the thing, here's the lesson. We're going to look at Spot. Is just some businesses that are easy to get our heads around and really popular. I love Spotify. I use the darn thing a lot. I like music, right? And it gives me the best experience. I used to be a Pandora user, but I switched to Spotify. Now, the fact that they have, I don't know, hundreds of millions of subscribers probably makes them a pretty attractive stock because everybody understands how cool the service is. But when you look at the fundamentals, I don't care about cool. I care about money. They just are not worth the price tag. Let's take a look. I don't think they're going to be worth $500 a share. Every time I look at Spot, it's grossly overpriced because a lot of retail investors, a lot of hedge fund managers, they buy it and they can explain it to their clients. Oh, I own Spotify. It's fastest growing music, service in the world, and it's super cool and deluxe and all that stuff. That's great, but they don't. I'd rather buy a boring software company that, I have no use for their product, but they make a bunch of money and generate a bunch of cash. I'd rather have the cash than the coolness. So we'll take a look at Spot. All right, Codis. Chubb. I love Chubb. Chubb's one of my big buys. It's in my video today. I bought more shares. I'm going to keep buying. I'll go over the financials with you and tell you why. Omar bought Amazon, not a bad idea. And Google, good ideas for the long term, buddy. Your head's in the right place. Amazon and Google will be worth more in the future. They're both good companies. Android PC. So Adobe, we went over Adobe. I don't know, Android, if you joined a little after I covered it. And then Intel, having you CEO, huh? Man, Intel's such a freaking basket case. I hate covering Intel now. Those guys, man, it's been a dumpster fire. So what's going on with Adobe stock? Let's see if the management team said, well, whatever they said made investors even more nervous. So now it's down 4.5%. Interesting. Man, Adobe cannot catch a freaking break. But we'll see where it trades tomorrow. We'll see where it trades tomorrow. All right. So we got through that one. All right. So we're going to handle Pfizer and see what happened out there. Why did the stock universe? So first, as mentioned in my opening remarks, the healthcare space was selling off. So J&J sold 1.5, Merck 1.46, Amgen down 2%. So these guys are kind of, they were guilty by association. Everybody in the healthcare space took a nice little haircut today, but the space is doing well for the year, so I wouldn't be overly concerned. For the year, this thing is down 3%. It's down 9.38%, but I continue to think this is going to be really work because the market is not paying attention to the quarterly growth and what they've been doing to their business to make it much better. And they acquired businesses with all the money they made on COVID. And those businesses are now generating cash, profit, cash flow. So this is a stronger, bigger business. $17.7 billion in the most recent quarter. They grew that from 13, which was 2023. The compares are just going to keep getting better and better for Pfizer. And Pfizer is going to be a winner, in my opinion. I think Pfizer is discounted, and I keep buying shares. These numbers are going to keep improving as they prove their growth. Right now, conservatively, I think they have a nice discount of 33, but I think it's going to keep getting more valuable as their story matures. They have to execute. That absolutely is a necessity for Pfizer. But let's see what analysts are saying. 12 analysts cover it. They also believe it's discounted. So I'm not alone in believing that Pfizer is a good idea for 2025. Spotify. So, man, I'll just keep my subscription to Spotify. Make money elsewhere because this thing's always priced too high. Even analysts are like, even after this, there's been a price pullback, right, from 600 down to 535. And analysts are like, it's fairly priced. When we follow this is a $110 billion market cap company. They're growing at 18%. What these guys are, they're kind of a software play. They're a platform play. They're like a Netflix, right? You stream stuff. And their margins should be good. Let's take a look. Gross margins not very good. 30%. That's a surprise. That reminds me. Okay, so the margins are kind of bad. So their profit is kind of low. Free cash flow 2.2, let's call it 2.3 billion. Now cash flow historically has been terrible. It's a $110 billion company. What's their cash flow? Free cash flow margin historically was 5%, almost zero, 3%. You could do better with bonds than this. And that's not a very good compare. You're a growth company. You shouldn't be that low in free cash flow. All right. 2.3 billion at their growth rate, low margins. I'd want to pay 40 to 50 billion dollars for this business. I'd multiply that by roughly 20. And they're at 110. I'm nowhere near the value that I need to be in order to say Spotify is a good investment. Nowhere near. And I think at some point, I think the reason why the margins are not as good as, let's say, CrowdStrike or Zscaler, Sentinel One, or Adobe is they have to pay the artist, right? So if you go on Spotify and you're listening to Taylor Swift's making money when you're listening because they have to pay every time an artist gets played, Spotify is going to have to pay for it. So they're not completely making the margin. Like Adobe, if you go and buy Adobe software, they get to keep all the profit. They're not sharing it with anybody. So that's the big difference. And I am not a Spotify buyer, but I am a fan. All right, a couple other stocks that came up. First one is Chubb. I think Chubb is a fantastic opportunity for me. And Warren Buffett is an investor in this stock. It's doing pretty good year to date. It's up 3% in a year like this. That's a win. 1 year, it's up 11%. Over the 5 years, up 116%. This has a super low PE. And when we look at their growth, decent growth, 12%, 16%. So they're really profitable, really good growth. I have a very good valuation on Chubb. This was one of the stocks that I said was one of my biggest buys right now because they're just highly discounted. The insurance business, they make sure they're going to make money and they get to hold all the premium money and invest it in the near term. They win two ways. They're profitable on the insurance policies they sold, and they get to be profitable with the money they're investing. That's really premiums that have been paid. They get to keep the money until the claim is made on a policy. Chubb is a great business. Warren Buffett is an investor. So I like Chubb. Buying that up. You want more details? Watch that video I released today. It's a good one, and you ought to watch it if you're interested in Chubb. Amazon is priced well. I think Omar decided to go into Amazon today. And this is, along with everybody else, it's pulled back really nicely and pulled back to a price that is a pretty good price to go into the stock. It's a terrific business, $2 trillion market cap, $638 billion in revenue. They became the biggest revenue company in the United States, surpassing Walmart. See you later, Walmart. There's a new sheriff in town. It is Amazon. Get out of the way. Get out of the way, please. I think it's fairly priced, but on a stock like Amazon, it's a good one to have. I own it. I own Amazon. Would I buy more Amazon shares? Absolutely. On dips, it'd be a buy for me. It's a terrific business. They're really powerful. They got great moats, and Amazon's a terrific stock to own. Google is in the same boat. Google is a terrific business, and it has a better discount. If you asked me which stock would I buy if I only had $1 to invest, an incremental dollar, and it would probably be with Google because it has a better discount right now, 34% versus Amazon's close to fair price. 34% because Google, I think they've been behind on strategy. Like if you remember a couple of years ago, the AI story was ahead of them. They had to keep explaining why they weren't leaning into AI. Now they have a fabulous AI story, but the AI story is a little late now. It's kind of gotten old. Well, they're still trying to sell the AI story. It's like, guys, you got to be ahead of these curves. Don't be behind them. But aside from that, their businesses are awesome. Their search business, YouTube, and their cloud business are doing great. And then they have this robo-taxi business that's real. It's not like the robo-taxi business that Elon Musk's talking about. He just tells this fantasy of, oh yeah, we're going to magically have all these cars going around giving everybody rides. We haven't qualified any of the cars. We haven't done the hard work of proving that out. Like Waymo's been doing it for 15 years. He just kind of tells a story, and in my book, the Tesla story is a fantasy, not anything else. So that is Google, and I think Google is terrific. All right, so we covered that. ZRD, you got some more NICE shares. Man, NICE is a good business. It's a software company. Let's take a peek at it. It's just like some of these software companies just get beat up, man, for no reason. Junior Pacheco, good to see you again. So is that B-A-Y-N? So I'll take a note of that. All right, so we'll take a look at that. So we're going to look at Nice Software next. So Nice Software is having a nice bounce after hours. That looks good. The stock hasn't been doing all that great. It's down 17% for the year. But what I don't get is these guys keep growing. They're not the biggest software company in the world, but they're pretty good size, 15% growth. They have great cash flow of almost 800 million. They have good margins. Now these guys are in the call center space. They do software that helps in the interaction with customers, whether you're calling into a call center or you're doing something with a company, and they're really innovating in providing AI use cases and experiences for their clients to offer their customers. And I think that's going to go somewhere. In the meantime, this is really discounted. Nice as a company is discounted. I decided to buy because the discount was really attractive. In the near term, if companies get priced below their intrinsic value, it could really offer an investor a really nice discount. So I like that. Nice Software is discounted by 72% if I measure their cash flows. So that looks really, really good. And then overall, with their earnings per share valuation, it's a 54% discount. Now, this is a smaller company located in Israel, out of my home country, so I give it a higher discount rate to make sure I'm going to have a great return on investment. And so far, I haven't changed my sentiment about this stock. I think it's a terrific stock. So I like Nice Software. I'm just not putting a lot of capital in there because it is a smaller company. It's riskier. So I'm going to I put some money there. I'm going to let it ride, wait for another earnings before I make a decision to buy any more shares. But I decided to buy shares in Nice. All right. So then you wanted to ask about BAYN. And I think, is that Bayer? BAYN. AYN. Yeah, it's Bayer. Which one did I look at? All right, let's take the top one here. So the German stock market's been doing really well, by the way. Kind of like the secret's out. This one's up 19% year to date. That looks great. So this is a smaller cap. This is in euros, which is close to 1-to-1 with the dollar. And it is a drug manufacturer, pharmaceutical company. Okay. Hasn't been growing. Let's take a look at the quarterly. So no growth. That's interesting. And free cash flow 45, 4,590,000,000. If they can start growing, then their valuation is going to be much higher. Quarterly, no growth. Interesting. Even though they're not growing, and let me look at their margins. These guys are worth a lot. Gross margins of 56. So this is a pretty good idea. See how the stock's really sold off by 60%? Why is that? Do they have a lot of debt? So total debt almost 41 billion. So they have net debt of like 33 billion. Okay, that could be a problem. Debt to EBITDA is 4.13. That is a very high debt level. That is a high debt level. If I looked at the value of the business, it's like 45, 50 billion minus debt. You get down to 20 billion in value, maybe 15. That debt is what's weighing down this stock. This wouldn't be a good investment for me. The debt's too high. It's risky. These guys can get themselves in. They're already in some hot water, and they got to service that big debt. So I'd be out. Debt's too high. You got to always keep an eye on debt, okay? Debt is very bad. Debt to EBITDA is the ratio that tells you um, how quickly they can pay off that debt. They really focused on it. Here, it would take 4 years and roughly 3 to 4 months. That's a long time to be dedicated paying off debt. You wouldn't be able to grow any. Your competitors would take market share from you. You want that to be as low as possible. Software companies tend to be at zero, showing really strong balance sheets. It's pharmaceutical, they've been around for 100 years, and that's not an exaggeration. So some of them wanted to grow, so they borrowed money. They either acquired other businesses or they built factories and they deployed capital inefficiently. Back to Pat Dorsey, he really wants businesses that deploy capital efficiently. He doesn't want businesses borrowing money and trying to acquire other businesses that don't make sense and stuff. So this one here, it's a walk away. There's not enough value. There's too much trouble. I am out. I'm not going to BAYN. It's Bayer, the pharma. They acquired Monsanto. See, that acquisition isn't making sense right now. They're not growing, and they got a bunch of debt on their balance sheet. Yay, that sucks. What do you think about Teva? So Teva's pharmaceutical. I believe they do generics, meaning they don't make as much margin. But let's take a look. And it's good to see you, Michael Anthony. I'm always recently you made a bunch of money on Herbalife, right? So I'm always thinking, as soon as I see your name, I think you made a bunch of money on Herbalife. So congratulations on that. So 1 year up 23%. It's down year to date. Okay. So it's an $18.8 billion market cap company. Forward P is 6. If I remember right, these guys are a generic company. So they get to borrow or they wait for patents to expire and then they can process those drugs. So that's why they have a lower gross margin. The companies that have the patents, they're making 80, 90% margins where these guys make 48. It's still a pretty decent business. It's not going to be a high growth business, I don't think. They're waiting for these drugs to go off patent and they'll just be a slow grower. And they had a really bad run for a while. Now they're growing a little bit, which is more encouraging, but the latest quarter was negative. This is a little bit, there's a lot of opportunity in healthcare. It's great when you have lots of choices and you pick the best one, right? Teva's not even close to being the best one, in my opinion, because you have a lot of terrific opportunity out there. This one is not so far afloat in my boat. $749 million. They're slow, no growth company. They're worth like 7.5 billion minus debt. How much is the debt on the books? The books say you owe $15 billion. Why do you owe so much money? It's going to take you forever to pay it off. This is like debt to EBITDA, 4 years. Too much. I'm out. Teva. No way can I invest in you. First, you're overpriced. Second, you have too much debt. Adios. BAH. What is the story? Man, we cover this company every week. These guys are insurance. No, wait, sorry. Booz Allen Hamilton. They do professional services. Now, professional services is not like software. And I'm going to cut right through the chase. They're in the same ecosystem, but when you go to margins, you have a very different margin rate, 23%. Adobe, 89. Booz Allen, 23, because they have to hire a lot of professionals to do the work. So these are not very desirable businesses, not enough margin. Competition, consulting firms are being started every week. There's always going to be competition at all times. 14 billion, we've analyzed it. The conclusion was it's not a buy for me. I'll cut right through the chase. They're not doing well for the year. They're not doing year to date. We go into recession, these guys are going to be hurting. They're going to be hurting. So don't get, not saying you did, but if anybody looks at this company and says, oh, they seem like a technology company. They do management, technology consulting, analytics, engineering. Yeah, but it's kind of like the analogy I've used before. You have a football team and the quarterback gets paid $50 million. The equipment manager gets paid $60,000 a year. We get to pick the software companies or the companies that we get to invest in. We'd rather pick companies that resemble the quarterback that gets paid 50 million versus the equipment manager. Both those titles are in the same team. They're in the same ecosystem. They go to the same games. They both suit up and do the best they can at their jobs. But one occupation is far more valuable than the other. Software companies are really valuable, consulting companies are not. So that's the conclusion there. Thanks for asking there. All right. And that was Joey that asked. Very good question. Michael Anthony. You have any idea why Pfizer dropped 2 days in a row? The market's been, I mean, I don't think I need to convince anybody. The market's been really wild. And healthcare today dropped together. So that I would say the space dropped. It was in rally mode. Healthcare was in rally mode when technology was in trouble. But technology did well, so healthcare took the back seat. I still think healthcare is going to outperform technology this year. So I'm still buying. I mean, I'm buying across the board on healthcare. I'm buying Pfizer, Catalyst, United Therapeutics. I'm buying Halo, Oscar, Elevance Health, CVS. Buying it. Like every day I'm buying shares and I want to load up. I think healthcare is going to be the place to be. Joey, how low would Target have to go for you to buy it? And you're talking about Target, the retailer. I don't like retail, Joey. And I think I remember you now. I think you're a young investor. Were you 18 years old? If I remember that right. I think you're talking about Target. Now, Target is one of those businesses. We all know what a Target is, right? Or Target, as some people would say. And yeah, we can get our heads around it. It's a retail business. We go in there, we buy our stuff, we check out, and so forth. Simple. They're just not very valuable. And a lot of retail investors are like, oh, Target, I know what they do. I'm going to buy. And they teased me with this dividend. Ooh, the dividend keeps getting better. Don't be teased by dividends. Dividends have very little to do with the value of a business. It's just a teaser. It's like, come spend, $100 buying a $10 dinner. Oh, but we're going to give you a really nice hors d'oeuvre. Who cares? Just go to a different restaurant and get the meal for $10. Target is just not a valuable business. Why? Let's take a look at their fundamentals. Do they make a lot of money? When somebody goes in and spends $100 at Target, Target only keeps $28 out of $100. The margins are terrible. Now let's think about the business. You got to lease out really expensive real estate, and these stores are huge, huge footprint. And you have big parking lots. You got to hire a bunch of employees. Then you got to manage a very big workforce. Outlet is expense, cost, and risk. And then you put stuff on the shelf and you're making 28%. No, thank you. Wouldn't it be better if we just had a software business? And look at the valuation of Target, right? 48 billion on revenue of $106 billion. Whew. Now, 106, I'm going to think on the fly here, and we're going to go to Meta. Meta is 164 billion, not quite the same, but kind of in the same neighborhood, right? Meta's just $60 billion bigger, but the value is 1.57 trillion. So we're going from roughly $50 billion of market cap value. If you wrote a check for $50 billion, you can buy Target. Meta, oh, that's a big check, 1.5 trillion. It's roughly 30, let me think on the fly here. So it'd be, I guess, about 31 times more valuable. revenue-wise, it's only 60% higher in revenue. It's not even 2 times bigger in revenue, but it's 31 times more valuable. But when you go to the margins, when $100 of revenue are performed on the Meta platforms, Meta gets to keep $81 of that revenue. And do they have to rent out, lease out a bunch of real estate? No. It's on all our computers. We're the ones that are providing the device that we use, Facebook and Instagram and WhatsApp on. Do they have to hire like a huge population of employees? No. They have skilled programmers, developers. So the difference between Target and businesses like Meta is very clear from an intellectual perspective. One business is far more desirable. What I encourage you as a young investor to understand is don't be lured by something that's easy to get our heads around, Target. Study how much money is being made. And I would encourage you to go the opposite direction. Go find businesses that make a lot of money that are hard to understand, like Meta, although Meta in a way is easier to understand. They make a lot of money, almost 82% margins. They keep a lot of it in cash. So go find businesses that look like that in industries and sectors that it may be challenging, but you can teach yourself how to understand them, because that's where you're going to make a lot of money in your lifetime, is if you can find businesses that are going to just explode. Let's look at Robinhood. You can probably get your head around Robinhood. So we're done with Target. Target's not a good idea for a young investor. It is a place where money goes to either sit idle or go down in value or go up slightly in value. I want places that you put $10,000 in, you show up 5 years later, it's worth 50. You show up 10 years later, it's worth 100. The same $10,000 has been working every year to increase my wealth. So we were talking about Robinhood. Why was Robinhood catching my attention? Okay, so we know what Robinhood does. I think everybody on this call knows they're a brokerage. But when we look at their margins, and so operating margin, that's like after gross profit and so forth, 36%. Profit margins, and that's another assignment for you, Joey's. I know you're super young. Learn to read financial statements. That is the language of stock investing. And if you expand your language and your vernacular, you will be able to make great decisions. So you got to learn financials. The difference between gross margin, operating margin, profit margin. Profit margins, once everything's paid for, that's what's left. And Robinhood, after everything's paid for, they get to keep, if $100 was sold, they get to keep $47, which is huge. It's really big. And they get to keep a lot of profit. So when we look at a business like Robinhood, it was a very small business from a value perspective. I showed you Meta is a 1 trillion. These guys are still tiny, and they've been really going up in value. If we look at the 1 year, these guys went up 130%. So you put $10,000 in a year ago, and then you go look at your bank account, and it says $23,000. That's what I'm talking about. Yeah. And hopefully, if Robinhood keeps going, you leave that money in there in that stock, and 4 years later, you go look at your accounts worth 50,000. That's, for a young investor, that should be the goal, is try to find really good quality businesses that are growing, that make a lot of money, a lot of profit, a lot of free cash flow. And that's the path. That's the path we're looking for. We're not looking for 2-3% gains over a course of a year. No, that defeats the purpose. If you're going to invest in stocks, we're going after 15-25% gains year after year and let that compound. so you can really grow your wealth, especially if you're investing when you're young. You're going to make a few mistakes, but as you learn and get better and better, by the time you're 30, you're going to be making good money, appreciating your wealth. By the time you're 40, you're going to be unstoppable. Unstoppable. All right. Good stuff, man. All right. So, what about SPGI? SPGI. So S&P Global, these guys have been doing really well. Their stock's really appreciated, up 100%. Very good. Just every time I look at these guys, again, they just get priced so darn expensive, but they've really had a strong pullback. Look at that pullback. What happened? Why is it more exaggerated there? So 542. They went down roughly about 10%. Not too bad. So whenever I value these guys and others, I get to a fair value. Their growth is good, 13%. The most recent quarter was at 14%, so that's pretty accurate. And gross margins are good, 69%. These guys are doing transactions and data services and so forth. Free cash flow, 5.5, growing really nice recently. So these guys are worth, I don't know, it depending on the debt, because I was going to say 80 to 100 billion minus debt. And their debt is substantial, 10 billion. So let's call it 70 to 90 billion in value. And their market cap is 147. So I'm not even close. Every time I look at SPG and there's like a pack of these, and investors that invested in them, they're doing well. I just see that they're always priced pretty expensively. And I don't get it. These guys are kind of data services, they do exchanges, but they have a pretty good moat. They have a good moat. I would give them that. They just don't make enough money and they're not growing fast enough. I'd rather be in a Meta or Google or something that is growing faster and creating more value and becoming more important. So SPGI is not a great one for me. I've never invested. If a company like this, and their margins were at 69%, which was okay, what would be a good stock comparison wise? I can't even think of one. So that's my answer on that one. So railways are always, so Unir, railways, and I don't know what your age is. If you're under the age of 40, just railroads, if you want to make a little bit of money, rails are pretty good. If you want to make a lot of money, you can't expect it in railroads. This is 25% rate of return over 5 years. At that rate, you can put it in a nice, safe, bond or a bond ETF. He'll get to 25%, no problem. You'll get a nice rate of return, and you won't have the risk of a stock. This is 25%. Add the dividends over 5 years, you're up to 35, 40%. It's a decent return. If you're looking for decent, go rails all the way. If you're like 60 years old and you want to preserve your wealth, rails are a good idea. Really good idea. Because you're not wanting to take big chances. You don't have time to recover. You don't want to have to go back to work if you're already retired and so forth. But if you're like 30 and you're like, hey, I got 50 grand. I want to keep saving. I'm going to keep putting money in the market. But I want to wake up in 30 years and have $1 million. Okay, we got to think bigger. We got to think stocks that are just going to keep compounding at a higher rate. We got to think, software companies, biotech companies, pharma companies, communication services companies like Meta, Netflix, Google. We got to think about these businesses that have become gigantic and not necessarily looking to invest in the gigantic companies, but get the idea. Like Why did Microsoft get so darn valuable? They're worth almost $3 trillion. They're a software company. Okay, well, let me go find smaller software companies that make the same profit as Microsoft, that have great ideas. They're going into spaces that are brand new. That's where the money's at. So the big stocks teach us this is the map to where the big money's made, but it's not in these brands, right? It's not in these stocks. You got to go find the equivalent that's maybe a $50 billion market cap right now and will eventually be a $500 billion market cap company. Go find that one. If you find that one's going to be a rocket ship that's going to compound your money fast. You go down the list and you go, hey, Google Alphabet, their communication services, Meta communication services, what's the next social app that's going to be super successful? What's the next so forth? Now, the idea is the starting point. Fundamentals have to be behind the idea. For example, Reddit might come to mind. Reddit fundamentals are not good enough yet. And then other companies like Snapchat or eBay, not good enough yet. They're not very good. So that's some ideas of how to generate ideas of where you can find super big winners. So this is an expression, right? Whoa, I think I hit the wrong one. Sorry. How do you feel about time in the market versus timing the market? So I'm a dollar cost average person. Like right now, we just went through a pretty good sell-off. So we're seeing some stocks that are discounted. So I dollar cost average, like I said, I was buying healthcare stocks, I dollar cost average in. So the expression should not be interpreted as at any one time, you should have 100% of your net worth in stocks. You have no cash left over, right? So I think if an investor was invested 90% of their capital at one time, that would be like rounding up, you're fully invested. But it doesn't mean you're 100%. I think if you take the literal meaning, you're supposed to be invested out. So just keep that in mind that, hey, if you got to fractionalize your portfolio. If you have a net worth, let's say 100 grand, you're 30 years old, and you have 80% into stocks and 20% into maybe some CDs that, hey, who knows what's going to happen over the next couple of years. I want to have some money that's going to be there. So that's diversification. So keep that in mind that, yeah, you want to stay invested. You don't want to be like, okay, I got 100 grand. I'm going to go all cash and then try to time the market. That is very difficult. Even the pros don't get it right. And most people get it wrong. And you miss out on appreciation. But don't take it literally like, oh, I got to be 100% in or 100% out. No. Think about your diversification. Like, I don't have all my money in stocks. I have a good portion in stocks. I have real estate. I have bonds. I have crypto. And I have cash on checking accounts and stuff. So keep that in mind. All right. Which software stocks do I like? Pretty good list of them. Just watch my channel. Go on there. You'll see them. Adobe's one of them. We covered it today. All right. So good stuff, guys. That was a good session. I really like how we went through Adobe, kind of soup to nuts, covered it. We talked about certain concepts. It's a really good session. I really appreciate everybody attending. Everybody have a terrific night. We've gone about an hour and a half. Very good stream session. Guys, think about being a paid member. You guys asked a lot of good questions. If you want to kick your development, your learning process much faster, attend the investor calls and really begin to learn faster. Consider that. You can get the details on this video or on my channel on how to get signed up. And I will try to stream again tomorrow. I'm not sure what time, but we'll see when that happens. Everybody have a good night. It was nice to have a green day. Wasn't it nice? It was nice to have a green day. I can go for another one if the stock market would be generous enough to give us another green day. It'd be nice to have another green day. If anything, today was a break. It's like, man, huge losses on Monday, losses on Tuesday. It's like, oh, okay, you gave us a break. Thank you. Thank you. And we'll see what happens tomorrow. We will see what happens tomorrow. All right, everybody. Have a terrific night. Take care.